Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer, where you get everything we provide in our platform, as well as unlimited commission-free stock and option trading for just $99 a month. It's what we use here today, and it's what we're going to spend some time digging into as we review our performance for the month of February 2019. Now, as you might recall, we ended January 2019. We were actually up a bit, and part of the reason we were up was we were able to get a few percent squeezed out, primarily because of some earnings trades. And there was a bit of risk involved, but we saw some opportunities uncovered by the tools. And our goal is to kind of move towards a more long-short book. And that's kind of a more sustainable way where you can express views and then hopefully be able to have those views turn out the way you want them to, while also balancing your book otherwise. So for this month, February, we've been practicing a much more conservative style of trading, where we really just focused on four stocks. And part of the reason for that was that we picked four directional views, and they really worked out in our favor, which was nice. We were bullish on Carnival and Microsoft, which carried over from January. Those are positions that we had. We just sort of we got out of them for earnings. Earnings came out, we got back in, and fortunately, in the case of Microsoft, the earnings actually worked against the company. But I'm just long-term confident in Microsoft, so it was very easy to get back in, kind of at a discount, and be able to use some option leverage in order to get some good returns on the cash we had there. At the same time, I did not feel great about Facebook after earnings, even though they went up. And then Teva had a fairly bad earnings result, or at least the market deemed it so. And so we took the opportunity to get a bearish position on them as well. And in our case, all these trades over the course of the month really went in our direction. So it was really more an issue of just managing the trades to try to roll when necessary to increase profits, and also, of course, to reduce risk. And in addition to that, over the course of the month, I was pretty, I ended up being pretty conservative about videos and about pushing content out, because I didn't see a lot of trades that I wanted to make. There wasn't a lot of work that we wanted to do, so we ended up just shipping weekly videos, just kind of like Friday recaps and then book adjustment, because that seemed to be all that we needed to do to be successful. Now, the net close for the month, we closed after all fees, everything else was at 27,487 and 93 cents, which means that we are up since we started in the beginning of January, or in the middle of January, uh, over 5%, which is awesome. We were up in January, we were up in February, and the goal is ideally for us to be up at least a little bit every month. We're not trying to shoot the moon here. I mean, we're not trying to hit home runs. We're not doing these YOLO calls on stocks, trying to get weekly returns of 10,000% and so on. We're just trying to gradually build a portfolio using a responsible options trading philosophy. And the techniques are going to vary, but in the case of what we're doing here is we're just trying to build using these tools. The tools are designed to help you find opportunities and capitalize on them, but then also, and this is super important, also to manage your positions once you're in place. And if you are dealing with commission-free trading, as we have with Quantcha Unlimited, you don't have to worry about the transaction costs for adjusting positions and moving things around. So this month we really didn't take advantage of it at all. We went real light on the adjusting, but um, but I'll kind of step out for a second to take a look at where we are with our current portfolio. Now today is what we would actually consider to be a relatively bad day, I guess you could say, because Carnival, which we're bullish on, is down. Facebook, which we're bearish on, is up. Microsoft, we're bullish on them, they're up, that's nice. And then Teva, who we're bearish on, is up as well. But what we're going to do here is we're going to use this as an opportunity to make some adjustments, and we'll just kind of go straight down the line. I looked through a few of these trades earlier just to kind of get a feel for where the market is right now. And one of the things that I want to call out is our two bullish positions, Microsoft and Carnival. We're just short on puts, which is a bullish position to be in. We sold the puts because we are going to profit on them moving up in value, or at least not moving down. That's kind of the key differentiator there. And for Facebook, and also for Teva, we sold call spreads, which means that we were short on the lower strike for the call and then long on the higher strike, because we want to make money off the the time value decay on the lower strike, and then we're using the upper strike in order to hedge it. And in the case of Facebook, we actually rolled down, I believe it was last week, where we were 165, 175, but we were able to roll that 175 down to 170 in order to reduce the risk we had at hand. So let's go kind of one by one here. First, we've got Carnival. I always like to work in the book manager to get a feel for kind of what the P&L is. There's no surprise here. I mean, this is next Friday. It's just this is at expiration, the position we would look to be in. I will go as far as to say that I'd rather just roll this out at least another week and then try to collect more of the time value. And Carnival is one of these companies where their earnings is still, it's a few weeks out. Actually, it's really not that far out at all. We get one more week of trading before they have earnings, so we'll just roll out today to the 15th, which will be the week before earnings. I don't anticipate substantial. At this time, I don't really think that there's a reason that they're going to tank between now and then. So I think what we'll probably do is we might move down to somewhere closer to where the money is right now, because that'll get us the most theta value, basically the highest amount of time value there that we can get the decay from. So simply put, right now we're looking at 58.5 for next week. We're going to go out to the 15th, and because they're at 57.65, maybe we'll do 57.50, or we'll do 57 or 58. In this case, if we go to 58, you see it'll cost us $15 to adjust our position, which means that what we're doing there is we're basically cashing in on what is, or we're locking in at this point, what would be a $50 intrinsic loss because we're rolling the put from 58.50 to 58. And then we're getting a little bit of that covered by time value as a benefit in our favor. And like I said, I'm actually looking closer to the 57.5 just because then we get more time value. There's a higher degree of time value here. As you can see, all the money here that we would sell for is completely time value at this time because the strike is below the current price. But I'm a little bit mixed here. It's kind of a coin toss to me, frankly, which one we take here. I think because I am bullish on it, I do see them potentially moving up. I know the markets continue to surge; it's been continuing moving up, so we'll just go with the 58s, and we'll take that position here. We can see it's a curved line for the yellow because they're not the same expiration week. If we move forward to that expiration, we can see we're looking at a fairly similar chart. We do have a little bit more at risk if we roll to this position because we are locking in a loss on the current position, but we'll just take it as is. We'll go to our track changes tab. It shows that we're going to buy back this put, sell this put to replace it a week later. So I'm going to trade and see if maybe we can get this close to an even trade when it loads. So net debit's at 2 cents for the midpoint. Let's try to make it an even trade. I don't think anybody's going to take that, will they? It's pretty close. We'll see. We'll preview the order. And we'll just let that sit for a bit. We'll probably have to come back and turn it into a debit trade. So after Carnival, I'm actually going to jump down to Microsoft. We'll do them next since it's also bullish. Again, like I said, I'm pretty bullish on them. They continue to surge forward. We were at 111 for our current strike. We might as well move up to 112 and change. I would say 112.50 here for the week after. So I'm going to just find that March 15th one. We'll go to right around the money, 112.50. Again, we'll lock in our gains. Oh, no, 112.50. So, yeah, I mean, I guess we'll try to collect. We'll move up to the. I'll be a little bit conservative here and just take the 112s. These are going to be out of the money, which is good because it means we have a higher chance of seeing all the profit. And I'm just going to take it as is. We won't spend too much time analyzing it. It's pretty straightforward. The 111, we're able to roll out 1 week and roll it up $1 a share, and then still collect a credit. So, and collect a pretty substantial credit here. So, we'll do that. We'll ask for the midpoint and submit that order. Again, we're basically trying to shave off a little bit of gain here and there, just a little bit extra cash. Now, these the bearish positions we have on Facebook and Teva are a little different. For Facebook, what we would have to do at this point, if we were going to roll it, we'd really have to roll. We could just roll the one call. In fact, maybe that's what we'll do today. Because the stock is up a little bit, what we'll do is, instead of rolling the whole position, I'm just going to roll this call down a little bit, just to kind of tease out a little more value. Like I said, with Facebook, the trading thesis behind this particular bearish trade was that when I think about Facebook and I think about a news item coming out tomorrow and its impact on the stock, there's very little I can think of that will make their stock go up. But there's a ton of things I can think about that are going to make their stock go down, and a bunch of risk that they have and a bunch of problems that could come up. So that's why I'm inclined to continue to be bearish on them. I'm going to keep our March position in place, and I'm just going to look to see if we can roll down to like around where the money is. If there's a 162.5, that'd be fine. It's a fairly small adjustment here. Again, it's also out of the money, which is kind of nice. And if we take a look at what it does for us here, it's going to open us up to a little more risk, right? I mean, in theory, if they surged up over that 170 mark, we could be looking at dropping $530 from the current position we're holding for them. Alternatively, we are adding about $100 in potential value if they don't go up from where they stand today. So since it is an up day, and if we take a look at the past month or so, you know, they've been kind of declining down. They haven't seen 170 since early February, so I think that might be okay for us to start looking at. Although with our new position, that's, in fairness though, we got to think about that's just saying 170 is our max loss point. So maybe we stick around. Maybe we see if we can roll this 170 down a little bit too. I don't want to roll and then not open up a significant amount of profit for us. So maybe we don't do this. But let's just say if we brought this to if we brought it to the 167.5, what that'll do for us here is it will we'll still have about an extra $50 or so in profits, and we'll cut down our losses by only about $50. So you know what, I think maybe we just keep where we are right now. We get rid of those pending positions, we revert to this trade, we just look to roll that bottom leg and make a little extra money. So now the other thing I want to look at here as part of that is the impact that it'll have on our book. So in the event that we place that trade, we're actually going to bring our delta down fairly negative. And I think part of that might have to do with the fact that we haven't closed out. Oops, should have gone to orders. We've only closed one trade. We closed the Microsoft trade. We didn't close the Carnival trade yet. Let's close this Carnival trade out so we get updated numbers on our Greeks. And then when we do that, and we get those updated Greeks, we should be able to see where we are for our numbers for the overall book, and then we can adjust the bearish position so that we don't want to get negative Greeks right now. Or at least I don't want a negative beta weighted delta. I'd like that to at lowest be even, but maybe even a little positive. So not sure what it's going to take to close this trade out. The liquidity for these options is not great. Plus we're doing the what is effectively a calendar spread here by rolling from one to the other, which means that market maker's got to be a little generous and help us out on closing this trade. I'm 90% sure we'll close at 5 cents, but let's see if we can't get 4 cents here. Give it a quick chance to think about it. I mean, it's just one contract, guys. Come on. Well, while that's hanging, let's take a look. Like I said, I think we're going to get that 5 cent trade. But let's take a look at Teva. This is the other one we're bearish on. They continue to have moved down since earnings. 17 is our magic number here because that's our low strike for the call, and then our hedge at 19. But the thing is, if you look at the value of that 19, it's pretty much at 0. So I think what we could do here is we could actually be a little more responsible and roll this in without changing much. We can roll that into, and this is just an arbitrary kind of number here. If we came into 18, right, what that's going to do is it'll drastically reduce the amount of risk we have on the table. So now our worst case scenario is we'll be down 250 from our current position, and we still have upwards of we'll still have a 150 opportunity for gain, or even if it stays where it is, we should look to gain about $86. So I think that's a position I like to move. We'll adjust that one, and then I'm not too worried. This is more of an independent trade that we're looking to make. So we would probably want to do this regardless of how the rest of the book shakes out. Although having that trade closed would definitely help us understand here what our book looks like. And at this point, I hate doing this, but we were looking at this. We had I think we're going to leg out of this one. We'll just show that real quick to see if we can't get a better deal. The order we have here, we're offering 5 cents, which is not too bad. If we go up to, we leg out, or we just do 1 more cent. I mean, it's not a major amount of money to change. We just want to do a little better than paying the market rate of that 15 cents, because that would not be what we're looking for here. The Teva trade, I guess we can notch that up to 11 cents. I don't really mind filling that. And the other thing to keep in mind with these, the pricing here for these kinds of trades is using the national, the best bid and offer. So in those particular trades, in order to get it filled, and everything has been filled now, it might show that, hey, this is a net debit of 11 cents, but that means that you need to find one individual market maker for a complex order who's willing to fill all your legs. So one market maker might be offering to, they might offer to buy one at 10 cents and sell the other at 21 cents, or a different one might be offering to sell it at 21 cents, but they might not both be willing to do it at a combined rate of 11 cents, and therefore that's why sometimes you put it in what the market rate is and it doesn't fill if it's a complex order. If it is a single leg order, it should definitely work that way. But rolling back out, the last thing we had on the table was we were looking at our Facebook holdings, and this trade we wanted to do, and I wanted to just double check where our Greeks would be. Yeah, so if we actually close this trade out, we're right around even for our book, so for our overall portfolio rather. So let's see if we can't get that. We'll see if we can get it at midpoint. Not going to mess around too much, just see if we can close the trade out relatively quickly. We got 108. We'll see if we can ask for 107 to change the order. And we're just going to slide this down until we get it filled. 107. Give it a few seconds. Or actually, we're waiting for that to take hold. Looks like 106 is probably oh, there we go. We got our 107. So now we can go out to our portfolio. We've adjusted all our positions. We're still looking pretty good. On the Greeks, as you'd expect, you want this to be positive, negative, bullish, bearish. Everything's got a positive theta because they're all credit trades. Because they're credit trades, also you'd expect Vega to be net negative, meaning that we would benefit from a drop in the implied volatility. And our gammas are all going to be negative just because of the way we structure our trades. But this number here, we're right flat as our beta weighted delta book is. So hopefully we're not going to be dependent on the market movement in order to make a gain. Since we opened the portfolio, we've seen for the S&P, I mean, it's really just been up for the last, since we started. If we go back, it was in the middle of January, we can kind of see, at the end of last year, we had a bit of a punishment towards the end of the year, but then it's just been a slow, steady rise up. We started trading around here or so when it was around 260-ish, somewhere in this range. And then now we're up at 280. So we've seen the market go up about 7%. We've had a gain of about 6% after all the fees and stuff. But again, we're not necessarily trying to beat the market here. It would be great if we beat the market, but the nature of the strategy that we're putting in place is to be market delta neutral. So we want to be this to be generally flat, because in the event that we see a crash or we see the market kind of start to decline a bit and we see some problems, what would happen is we have these bearish trades, and they would offset. And so as long as our bullish trades didn't completely fall apart, we should be able to at least keep the ship steady in the event of a market decline. If we take a look real quick at our allocation as well, another important thing is you'll notice we're over 80% in cash right now. So that's not, I guess maybe that's not 100% fair, because our Carnival and Microsoft positions are using short put margin as opposed to cash secured put margin. So we really would have, in theory, if Microsoft or Carnival were to drop to zero, we could lose a ton of this cash. But realistically speaking, the amount of the loss that we would expect to have, even under a significant correction, we still should have this cash position, this 83%, secured. So even if all these trades kind of wiped out, the biggest drop we would expect to be upwards of 15%. And while that would be terrible for us, that would be from a catastrophic market drop where the S&P dropped below 200. And under those circumstances, you'd be much worse off being in the flat market or in the ETF or SPY or whatever. And the reason I just bring that up is to say that while we've been in a pretty nice time on the market watching the S&P rise, the important thing to notice is that we are protecting ourselves from a drop as well. So it's sort of some peace of mind. We've got relatively low amount of our cash invested. We've been seeing good gains that are almost on par with the market. We're not losing much to fees. And hopefully, as time goes on, we continue to see a calm, steady, predictable rise with low volatility in the returns on our portfolio. That's kind of the goal we have in place here, and we're doing a pretty good job so far. Anyway, I'm going to wrap it up there. If you have any questions or any feedback, please leave us a comment below or hit us up at hello@quantcha.com. And I hope everyone's going to have a great March out there trading. And as always, good luck and good hunting.